Welcome traders, wherever you are. This is another Become the cTrader Master webinar. Together we are going to take a look on the cTrader and the stochastic indicator on the cTrader. We are going to dive into the powerful world of the technical analysis and explore how this popular indicator can help you to make more money and make more informed decisions. So today's agenda is understanding the stochastic indicator, definition, calculation of the stochastic indicator, key components, percent K line, percent D line, and the signal line, interpretation of overbought and oversold levels, and customizing settings for different strategic styles. Then we are going to talk about the using stochastic for entry and exit signals, identifying the bullish and bearish divergences, spotting overbought and oversold conditions for potential reversal points, utilizing crossovers of the K and D lines for entry and exit signals, and combining stochastic with the other indicators for confirmations. Then in the third part, we are going to talk about the practical strategies with stochastic on the cTrader. So swing trading strategy, scalping strategy, reversal strategy, and trend following strategy will be described. Then we talk about the risk management with stochastic indicator, setting appropriate stop losses, position sizing, and calculating risk to rewards ratios. Then, of course, some kind of advanced tips and best practices of combining combining stochastics with the other technical indicators for the synergy, and adapting to different market conditions using the stochastics. So the stochastic is a very popular tool that greatly enhances your forex trading endeavors on the cTrader. Let me just dive in straight on to this cTrader, let's say, platform. So you can see the situation that we are talking about. We got the chart of the US dollar to the Swiss franc, daily time frame chart, and this is the chart that we are going to operate on. Please notice that by understanding these components on the stochastic indicator and learning to interpret its signals, you will gain a valuable edge in the dynamics world of the currency trading. As with any analysis, a technical analysis tool, it's essential to practice and adapt your strategies to various market conditions. Remember, risk management is crucial, and always trade with a clear plan in the mind. Thank you very much for joining this webinar. So let's explore the power of the stochastic indicator together and elevate our trading skills to another level. So let's talk about the stochastic indicator and how to understand this indicator. First, let's apply the stochastic to our chart. How do we do this? We go to the indicators menu. We choose oscillators, and then we choose the stochastic. We swipe down towards the stochastic oscillator. We click here, and this is the window. The window of the stochastic indicator informs us that this is a momentum oscillator that compares the current closing price of an asset to its price range over the specific period. Okay, so it helps traders identify potential trend reversals, overbought and oversold conditions in the market, and it oscillates between 0 and 100 when values above 80 are considered to be overbought and values below 20 are considered oversold. So the calculation of the stochastic indicator involves key line and D line. The key line represents the current closing price position relative to the price range over a given period of time, while the D line is a smooth version of the K line, usually and typically using a 3-day simple moving average. I'm not quite sure if I should bother you about the key components here and how they are calculating. What I want to tell you is that we are going to leave these calculations as they are and just click OK to see what's happened. So this is what happens. We got the stochastic oscillator on the bottom of the screen, and with this kind of a settings. So the percentage K, percentage day is still applied on this on this chart. The K line represents more responsive line of these two. It moves faster than the other one. So if you for example want to see which one is the K line and which one is the D line. So again, you go here, oscillators, stochastic, and you can see that the K is green. Okay, so the K is green, D is red. All right, so D line, of course, is a 3-day simple moving average of the K line, and it helps smooth its fluctuations. As you can see, the D line is not that sharp. The K line is the green one, and it's very, very sharp. Basically, it turns sharply up and down. So what's the interpretation of the overbought and oversold levels? So the stochastic indicator is particularly useful in identifying overbought and oversold conditions, which often indicate potential reversal points in the market. So overbought, what does it mean? When the stochastic value cross above 80, right, it suggests that the asset is overbought and there might be a higher probability of a downward price correction or a trend reverse. When the stochastic value crosses below 20, like here, for example, or like here, or here, or here, or here, this indicates that the asset is oversold and there might be a higher probability for an upward price correction or trend reversal. Now, of course, we didn't customize our indicator for the different trading styles, but we can do it. So the default settings, as you can see for the strategy, let me just apply it once again so you can see it for yourself again how it's done. So the oscillators and the stochastic. So the default settings for the indicator are usually 14 periods for K. Okay, so this is the typical setting. So there's 14 for K. Okay, 3 periods for D. Okay, so D periods is free, and 1 for the signal line. Okay, but we are going, and okay, let's say 1 for the signal line. Okay, let's leave it like that and see what's happened. However, traders of course can adjust the settings based on their trading preferences. So short-term trading scalpers, they will be using like a 5 or 7 for K, and let's say because they want to capture more sensitive signals and want to capture quick price movements. For example, long-term trading, the swing and position traders might prefer a longer time period, like 21, for example, for K, or even 28 for K, which can help identify broader trends and reduce noise. So it depends on what is your trading style is, basically what is your time horizon. Understanding the stochastic components and how to interpret its readings will form a strong foundation for applying this tool effectively during Forex trading on cTrader. Okay, so mastering the concept of overbought and oversold levels will allow you to spot potential entry and exit points, enhancing your ability to make informed trading decisions. So let's just click OK, and you see what is going on right now with our chart. So how to use stochastic for entry and exit signals. Okay, the stochastic indicator offers valuable entry and exit signals, helping traders identify potential trading opportunities and manage their positions effectively. So what are the techniques to use the stochastic indicator on cTrader? First thing is, you can identify the bullish and bearish divergences. So one of the most powerful signals that stochastic indicator can provide is a divergence between the price behavior, for example, and the indicator. Divergence occurs when the price moves in the opposite direction of the stochastic oscillator. So there are two types of the divergences. Okay, so there's a bullish divergence. This occurs when price forms lower lows, but the stochastic indicator forms higher lows. So in our situation, you can see we have some sort of the bullish divergence here. That's the low. This is not the lower low, but they are in line. But here, there's the low, and there is a what? There's definitely higher low. So that's the bullish divergence here. And there's a bearish divergence. This occurs when the price forms higher lows, price forms higher highs, and stochastic indicator forms higher lower highs. So it indicates that the upward momentum is waning and a potential bearish reversal might be imminent. So let's just find out some good example of the let's just find some good example of the bearish divergence. Let me just swipe here. You can see it here. This is the first high on the stochastic. There is another high. They're almost equal, but movement in the price is way bigger, and then there is the down move. Okay, so the other thing is spotting overbought and oversold conditions, of course, right? So well, let's just swipe down to the beginning. As I mentioned before, overbought and oversold conditions can act as a potential entry or exit points. So when the stochastics indicator moves above 80, it signals an overbought condition, indicating that the price might reverse downwards. Conversely, when the stochastic indicator moves below 20, it signals an oversold condition, suggesting a potential upward reversal in the price. So you can use this overbought and oversold levels to time your trade, looking for the price reversals that align with the signals. The other thing is crossover of the K and D lines. So stochastic crossovers can provide a valuable entry and exit signals. When the key line, in our situation, this is a green line, okay, crosses above the D line, it generates a bullish crossover, indicating a potential upward trend. So conversely, when the K line crosses below the D line, it generates a bearish crossover, signaling potential downward trend. Okay, so you can see it here. Look at this. This is right a bullish crossover. Green one crosses the red one. Okay, so you can use these crossovers to time your entry and exits, right? So, for example, bullish crossover in the oversold region below 20, for example, somewhere here or somewhere here, like here, for example, might be seen as a strong buy signal, and the bearish crossover, like for example here, in the overbought region, so above the 80, can be considered as a strong sell signal. Okay, so that another way to utilize the stochastics. Then the other thing is to combine stochastic with other indicators for confirmation. So in order to increase the accuracy of the stochastic signals, traders can often combine it with other technical indicators or tools. Very common indicators to use with combination with the stochastic are, of course, the moving averages, right? So we talk about it. Then RSI. So you got the RSI here. Not a problem. Let's just apply it. MACD. MACD is very popular as well. So you got the MACD histogram, for example. And of course, one more that we didn't talk about, and let me just apply it to the chart. So there are the Bollinger Bands. Okay, so the Bollinger Bands are again a volatility indicator. So let me just apply the Bollinger Bands for you guys. There you go. For instance, let me just tell you guys that a bullish stochastic crossover, for example, here, by the price moving above the long-term moving average, for example, may provide a stronger confirmation for a potential uptrend. In our situation, if you want to utilize the Bollinger Bands, please take a look here. What's going on here? We are in the middle of the Bollinger Band, so we are back to the moving average. So that's the one standard deviation. That's the second standard deviation from the moving average. Okay, so this bullish crossover indicates a potential movement towards that moving average. We got the bounce from the extremely oversold conditions on the RSI, and we are moving higher. And the histogram of the MACD is showing us that the bearish, the difference between the moving averages is getting smaller. All right. So basically, what's the conclusion? Using the stochastic indicator for entry and exit signals on the cTrader can significantly improve your Forex trading performance. But you need to master the art of identifying divergences, understanding the overbought, oversold conditions, utilizing the crossovers of the K and D line, and you will gain valuable insights into potential market reversals and trend changes. Remember, stochastic indicator is not infallible, and false signals can occur, especially in choppy or in the sideways markets. Okay, so therefore it's crucial to combine it with the proper risk management techniques and additional analysis to maximize the effectiveness and make well-informed trading decisions. Always practice and refine your strategy before applying in live trading, and consider the using the stochastic indicator as a part of the compare comprehensive trading plan, full trading plan. Okay, comprehensive trading plan, basic. So what are the practical strategies with stochastic on cTrader? So each strategy that I will present to you caters to different trading styles and timeframes, providing traders with a range of options to suit their preferences. Because I don't know your preferences, but let me just share with you guys some strategies. So, for example, swing trading strategy. Yeah, let's leave the Bollinger Band. Let's leave the stochastic on the chart. With the swing trading strategy, how to capture trends with stochastic oscillators. So our objective is to identify and write trends using the stochastic indicator on the higher time frames, like we have right now, daily, 4-hour charts or higher. Okay, so what are the strategy steps? What do you have to do? We need to identify the prevailing trend. So we use the higher time frames to determine the direction of the overall trend, and we need to look for the higher highs and higher lows for an uptrend, of course, and higher lows and lower lows for a downtrend. Okay, so what do we have here? We have high, we got low, we have high, we got low. So we got lower lows, lower highs. We are in a potential downtrend. Now we wait for the stochastic confirmation. So we look for the stochastic indicator to be in oversold conditions, below 20, oversold territory in an uptrend, or in a downtrend, in overbought territory in a downtrend. Okay, so the entry signal in our situation, when we identified this market as a downtrading market, once the stochastic indicator confirms the prevailing trend, enter a trade when the key line crosses above the D line in the oversold region for the uptrend, or crosses below the D line in the overbought region for the downtrend. You set the stop loss, you set the take profit, and you can, for example, place the stop loss below the recent swing low, for example, for the buy positions, and or above the recent swing high, of course, for a sell positions, and set the take profit target based on the risk to reward ratio you are comfortable with, or by identifying significant support and, for example, resistance levels. Okay, so this is the daily time frame chart swing trading strategy, right? Using practical strategies with the stochastic indicator on cTrader can significantly improve your Forex trading outcomes. Whether you prefer swing trading, scalping, reversal trading, trend following, you can incorporate the stochastic indicator into your analysis and enhance your trading and decision-making processes together with the accuracy of your trades. So let's just talk about the risk management and with the stochastic indicators. So because the effective risk management is a critical aspect of the successful Forex trading. Okay, why the stochastic indicator can provide valuable insights into market conditions. Okay, it's essential to implement risk management techniques to protect your capital and preserve trading longevity. So how to use risk management principles in conjunction with the stochastic indicator. For example, how to set the appropriate stop loss levels. A stop loss is, of course, a predetermined price level at which losing trade will be automatically closed, right? So when using stochastic indicator, it's crucial to place your stop loss based on the specific trade setup and the risk tolerance. For example, for long trades, you set the stop loss below the recent swing low or a significant support level. So this ensures that if the trade goes against you, losses are minimized. For short trades, set the stop loss above the recent swing high or a substantial resistance levels, okay? This protects your capital in case the trade moves in unfavorable direction, okay? The other thing is position sizing and calculating risk to reward ratio. So position sizing refers to determining the appropriate amount of the capital to risk on each trade. So it is advisable to most likely to risk only a small percentage of your trading account on any single trade. Okay, so this is for the educational purposes only. When you calculate your position size, divide the amount you are willing to risk on the trade by the difference between your entry price and the stop loss level, and this calculation will determine your number of lots or units to trade. Okay, you got the key feature here. When you hover around, there you go, you got the pip value for the one lot, you got the trade value, you got the commission required, you got available margin for this position, for example. So you can see what actually you can do with your trade and how big your position will be margin wise. Okay, so if you, for example, want to trade one mini lot, and if you hover around this menu, you got all of the situation calculated here, all of the risk management calculations here. Okay, so basically you need to aim for the risk reward ratio at least 2 to 1. So you're risking 1 to gain 2 or higher, basically. So this means of course that for every dollar you risk, you should aim to make at least $2 in the potential profit. So the positive risk to reward ratio allows you to have winning trades that overweight losing ones. Okay, so please remember about this. And the other thing is how to avoid the common mistakes, how to avoid the fake signals with the stochastic. So stochastic indicator, as like any other technical tool, is not foolproof, and it can generate false signals, and especially in choppy, in sideways markets. So to avoid the common mistakes, please consider this. Please consider the following. Okay, following things like: don't rely solely on the stochastic. Always use stochastic indicator in combination with the other indicators or price action analysis to validate signals and eliminate noise. Okay. Avoid trading during the economic events because high impact news events can lead to the unpredictable market movements, increasing the risk of the false signals. And please adapt to the market conditions. Recognize when the market is trading, when the market is ranging, or it's in a choppy trade, and adjust your trading approach accordingly. So the other thing is, the last thing is, the most obvious thing here is to practice. Practice and analyze past trades. Before implementing your stochastic-based strategy in live trading, practice on a demo account to gain confidence, to refine your approach. Analyze your past trades to understand how the stochastic indicator performed in different scenarios, and learn from both winning and losing trades to improve your trading strategy continually. The cTrader allows you to analyze your performance. You have the analyze button here. When you click here, you can analyze past trades, you can analyze your performance, you have all of this statistics here that can help you to do this. Just take a look at this and learn from your previous, let's say, from your previous trading behavior. Okay, incorporating risk management principles with the stochastic indicator is a paramount to successful forex trading. Yeah, when you set appropriate stop loss levels, when you calculate the position size based on the risk to reward ratio, try to avoid making decision and analyzing and try to more analyze past trades, then you can protect your capital and make informed trading decisions. Okay, so please don't forget about this whatsoever. Basically, this is what I wanted to tell you in this webinar. This is what I wanted to share. This is the information I wanted to share you in this webinar. Please remember to be very, very you know, avid, let's say, learner in the forex industry. Please make sure that what you're doing is safe for your account, and the way you using this the, let's say, stochastic indicator is safe for your account. You will gain a deeper understanding of the versatility and the potential of the stochastic indicator that can be a part of your trading strategy, integrating the stochastic with the other technical indicators, adapting to the different market conditions, considering your trading style, analyzing historical performance can significantly improve your trading outcomes. Okay, continuously practice, learn from both successes and challenges, refine your approach based on the market feedback. As you combine the stochastic with the other trading tools and develop your expertise and your strategy, you will be better equipped to navigate the forex market with confidence and proficiency. So I wish you the happy trading, and I wish you to be the master of the cTrader and the master of the stochastic indicator in your strategy. That's everything from me for today. Thank you very much for watching this webinar. Thank you very much, guys, for your time. I hope that I explained the stochastic indicator quite simply and in a very informative way. I hope we will see each other on the next Become cTrader Master webinar next Monday, same time, same room as it is right now. So thank you very much once again, and I hope I see you guys next time. Bye bye.